Welcome everyone to our weekly webinar. This week we have a presentation by one of our amazing mentors, Bill Klecki. He is going to be talking about cash issues for new businesses. And just a little FYI, this is a 3-part series. So if you haven't signed up for the other parts, you'll be getting a link in an email that will allow you to do that. This is brought to you by SCORE Manasota. And Bill, if you just click, we'll get to the next slide. Just a little bit about what is SCORE. SCORE is a nationwide organization of volunteers. We have over 300 chapters and over 10,000 volunteers. Our chapter, which is the Manasota chapter serving Manatee and Sarasota counties, has been in existence for over 50 years. And we have nearly 90 volunteers waiting to help you with your business. If you apply for a mentor, one of these 90 volunteers will be assigned to you, and we can help you develop your business. Our chapter, we're very proud to say, has recently been recognized as a district chapter of the year. Click. So where in your business process can we help you? Well, literally from beginning to end. You're thinking about an idea. In fact, many of our clients, it seems, woke up this morning, thought they had an idea that came to them overnight, and they want to kick it around the water cooler. We're really great about helping you click through. Maybe your startup phase, maybe you actually opened a business and now you realize that you need some help, or you want to grow your business, or lastly, you want to sell or close your business. Well, you know, the alternative to that is you want to buy a business. We can help you. We have a team dedicated to buying, selling, or closing. All you have to do is apply for a mentor. Click. Where do you do that? You go to our website, which is score.org/Manasota. There's a big button that says request a mentor. You put in a little bit of information about yourself, including what your business challenges are, and you will be assigned a mentor. You can also look for the mentor profiles and choose your own mentor if you'd like. You can check on our other workshops. If you'd like to sign up for our weekly workshops, you'll find them there. You can do a nice, easy search using our search bar as well. Click. And lastly, I'd like to thank our community partners and sponsors. You'll notice a lot of these sponsors are financial institutions. If you come into one of these with a SCORE mentor on your arm and a business plan, they're going to start and listen to you a lot more than if you come in with a whole bunch of papers for them to wade through to figure out whether or not you're worthy. I'd also like to thank our community partners who help us spread the word about SCORE. So without further ado, I'd like to turn this over to our amazing presenter, Bill Klecki, who is going to talk to you about financial statements. Take it away, Bill.
Thank you, Diane. Good afternoon, everyone. I'm really not going to talk about financial statements. I'm going to talk about something that's slightly different, cash flow forecasting, which is really not a financial statement. One thing I can promise you, there's going to be no accounting in today's seminar. There will be some simple math, but wanted just to get across to you that the use of a cash flow forecast is one of the most useful tools you can use in business. And basically, it's knowing when you're receiving cash and when you're spending your cash. All businesses, regardless of what you're doing, whether it's a for-profit or non-for-profit, require cash to operate. The primary reason that businesses fail is because of a lack of cash or capital. The management of your cash is essential to the success of your business. Regardless of your stage, whether you're a startup, a small business, a mature business, an expanding or a declining business, or one that's trying to be sold, or you're in the process of buying, cash management is a basic necessity. Knowing how and when you're generating and spending your cash is a key component of your business. Cash or capital may be accessed through many channels, each of which have their own positives and negatives. This is a simple list. because accessing capital it's another whole complete separate seminar or webinar. I won't be going into any of the details here. I just wanted to provide you with the idea of the various types of sources you can get for your capital or cash for your business. Everything that you acquire for your business will require cash. For a startup, you're going to need to know and have sufficient cash available to not only fund your initial costs of starting up, such things as buying equipment, entering into a lease and so forth, but also have the ability to cover the operating losses that your new startup will probably have. Most startups and most small businesses, when they initially start, have a period of time when they are operating at a loss. By operating at a loss, I mean you are having a negative cash generation. You're spending more cash than you're taking in. One key thing to keep in mind is that for a smaller startup business, don't get too caught up in looking at where you want to be in 3 to 5 years and how you want to have a big office or a big warehouse. Really be looking at where you're going to be in the next 12 months. One of the things you need to do is to conserve your cash and to make sure you're not spending it when you could be saving it. For example, there may be an opportunity to rent equipment rather than having to go out and buy equipment completely. Short-term leases may be better than having a long-term lease. Anything that you can do that is going to provide you with cash flexibility is going to be very beneficial to your business, and it's going to be a key component of your success. Well, I said we're not going to talk about financial accounting or financial statements. I do want to point out traditional financial statements and what they are. You have the income statement, the balance sheet, and what's called a cash flow statement. All of these statements look at data that's happened in the past for a period of time. It could either be a month, it could be a year, but all the data is past history. It's not what's going on right now. None of these statements provides a view of your current cash availability. All of these statements report on activities, as I said, that are in the past, and they're helpful to look at things like comparison between what you did in the month of May in 2003 compared to May 2002, whether you're improving in your revenues and your profitability, but they really have a lot of limitations. One of the limitations there is you don't have a real-time view of your cash flow. It doesn't help provide you with any advanced warning of potential cash shortfalls, nor do they give you an idea of whether you're going to have any excess cash that you can use for other investments. My viewpoint is that using only traditional financial statements or reporting to operate your business is focusing on both where and what you have done and not where you're going. Sorry, I want a bit of dry mouth. Cash flow forecasts. These are a forward-looking tool. It's not a financial statements. They're just a tool to look at your cash and your cash position. The cash flow forecast doesn't care about any accounting rules, but it is entirely focused on when you receive cash and when you spend cash for your business. This has a number of benefits. As I mentioned before, using a cash flow forecast can help you give you an idea if you're going to have cash shortfalls. It can help you plan and prioritize. It can help you look at how you manage your business in terms of the selling terms you have for your customers, whether you have 10-day terms, 30-day terms. It can provide you with an opportunity to know when you're going to need additional financing for growth. And it can also use it for tracking financial impacts of your business decisions. You can use some either or analysis and say, if I do this, this is what's going to my cash. If I do that, this is what's going to happen to my cash. And find out whether you have an appropriate level of cash to manage your business. While the format of your cash flow forecast is entirely up to you, there are no rules. And you can create either monthly or weekly cash forecasts. You can make them as simple or as complex as you decide is useful for you. Over time, you can also go through and change those and track different items than what you've previously been tracking within your cash flow forecasts. Once you've started creating and tracking your cash flow forecast, it's important that you compare your forecast to what's actually occurred. This will allow you to continually improve your forecasting as you learn from the past For example, if you find out you're continually overestimating the cash that you'll be receiving, your cash inflow, you'll need to lower that. Likewise, if you're constantly overestimating the amount of cash that's going to go out of your expenses, you want to lower that. So you're modifying your expenses with your knowledge of what's actually occurring to make better estimates. Personally, I prefer the usage of a weekly cash flow forecast with a minimum 13-week rolling period. What I mean by a 13-week rolling period is you constantly are looking at the next 13 weeks and projecting your cash inflows and outflows for those weeks. The way you achieve that is you update your actual cash for last week and actually what happened, and you add another week at the very end of it to make you to get you to 13 weeks. There are a lot of variables that you're going to find during in providing or preparing a cash flow forecast. For example, you're going to have some expenses that only happen once a month, like rent, or then you have other expenses that happen periodically during the month, like payroll, which could be every Friday, it could be every other week, it could be the 15th and 30th. You're going to have some expenses that are semi-annual and annual expenses, insurance premiums, for example, annual licenses, subscriptions to software, licenses for software. Then you've got some expenses that are being based upon the invoice date and receipt dates. Your business may have seasonality in it, and particularly in Florida, there's a lot of seasonality, and we're getting ready for the snowbirds to come back in a couple of months. All of the variables that impact your particular business need to be considered when you're preparing your cash flow forecast. And as I said before, as you continue to use this tool, you'll find that your estimates will improve. Now let's move past the concepts and look at some real examples. This is the basis of a cash flow forecast. You can see it really is very simple. You're looking at your beginning cash balance. The cash that comes in is your cash inflows. Those are positives, that adds to your cash. Anything you spend money on are cash outflows, or things that take away from your cash. And the result of taking your beginning balance plus your cash inflows minus your outflows will give you your ending cash balance. It's a very simple formula. And you just need to begin using this tool or using a similar tool to provide, and using whatever detail works for you. You can put as much detail you want into your inflows, your outflows, and I'll get to some more examples later on, but this is the basis for it. As you can see in this example, I've used a spreadsheet and I've put my weeks in the rows. However, you can also change the format around and make your weeks in the columns. Either format works. It's really what works for you that's important. And the key thing is to start doing it, to start working on cash flow forecast and really tracking your history of what cash is coming into your business and what cash is going out of your business. I mentioned previously that I personally prefer a rolling weekly cash flow forecast with 13 weeks. And if you look at this and count the weeks, you'll see there's 13 here. This has the benefit of being the most accurate estimate you're going to have, because it's the most current information. You're not looking that far out in advance. If you think about 13 weeks, that's basically a quarter in the future, or 3 months. This example, though, will show the variability of cash that may occur within a monthly time period. You can see that cash is $5,500 at the end of July. You're at $2,200 in August, and at the end of September, you're at $1,000. We don't have the end of October here, but you can see some big numbers in your monthly forecast. What you don't see if you're using a monthly forecast, if you only had these 3 numbers you were looking at, you would realize the cash is getting tight, but you wouldn't necessarily see that in the week of 10/9, you may have a cash shortfall. This is pretty important information to have. And this happens in the very bit within a month. You can have, because you have receipts come in 1 week, cash goes out another week. But when you see that you're going to have a cash shortfall, you then have the ability to go back and look and say, okay, what can I do about this? Because remember, we're now looking at this in July, and we're looking out into October and saying, I may have this happen. This is not a definitive, but this is what your forecast is showing you. So you can look at accelerating your receipts of cash from your customers. You can look at deferring payments. You can look at a lot of different options. The main thing is that you can manage toward not having this happen. By doing that, that will help prevent you from having to surprise yourself and from surprising your banks or any other people. And particularly having a cash surprise where you have an overdraft is not a good thing for a banking perspective. This is just a theoretical example of what a startup looks like. Almost all, and I would say all, but there's probably one that didn't. Cash startups are going to be cash drains. You're going to need a lot of cash to start your business and fund your business. To be successful, you're going to need to have planned ahead and to look and determine how much cash you're going to need to not only buy things at the beginning before you begin operations. You can see the cash being used is going down significantly here. Then also when your operations start, most businesses that are beginning operations for a period of time, most startups, the things you hear about private equity groups, all these new companies, you look at companies like a Twitter, which is now X, or any of those types of companies that are out there. When they first started, they were using a lot of cash to fund their operations. To keep this graph readable, I really just assumed and estimated that in this particular case, we did a really good job of estimating how much cash we were going to have. That's why this cash line never goes below zero. It gets very close to zero, but never goes below zero. Therefore, we've obtained all the cash that was necessary to fund the business. So you can see that over time, the cash that we have available is declining while our operations are slowly gaining momentum and working up to a break-even point where our profitability is now actually generating cash. The main point of this slide is really that before you start a business, and even in your new small startups, you need to make sure that you've done a reasonable estimation of how much cash is really going to be required to start your business. You got to make sure you accounted for things like equipment, leases, licenses, and the cash to fund your business until you become profitable, to fund those operating losses that are going to generally are going to happen with a new startup. I want to give you a little bit of detail of how I've actually used this in the past so you can get an idea that it's not just theory, but something that's a tool that I use. The previous examples were just to show you the concepts. The next two examples are going to be from actual cash flow statements, forecasts that I've used. There's a lot of data over here on the left that gives you information about this company, and I'll summarize some of it. But this forecast that you're looking at was actually a weekly forecast that was created in September of that year through year end. But for ease of actually reading it, you can see it's relatively small as it is. You can see that we were tracking a lot of variables on expenses. We had our beginning cash balance. We knew our cash receipts. It gives us our available cash. And then we have various other expenses. You can see things like rent, payroll, inventory purchases, CapEx that was planned. And then you see cash out and revolver advances. That's the cash that we were getting in from our bank line that was helping us stay afloat. As I said, this is a snapshot of just those 3 weeks. And what I want to point out is that this company had been seeing a decline. I got involved into it in September of that year. They asked me to come in and help them out. They have been struggling with revenue declining. They were trying to figure out what they were going to do. But at the same time, what added some more fuel to the cash fire, if you will, is that they were planning on opening up a brand new location. And in doing that, they had actually decided to pay for the build out of that location themselves. So they were paying for that, and they were also planning on hiring a lot of new people for that location. So they had two parts of a storm happening. They were starting to see declining revenues, their cash was decreasing. They had planned expansion, so they were spending money on that. And then the third sort of piece of the stool that was leading to a bad outcome was the fact that they had budgeted for a 10% revenue increase, and they were actually seeing this decrease, but they were hiring people as if they were going to have a revenue increase. Since this is a mature business, they had a lot of information that was there, so we could track all this detail. Once we started projecting the cash for the remainder of the year, it became clear that there was going to be a continued decline in revenue, and that there was going to be cash problems. You can see it, there's a negative $1 million in the week of December 10th of that year. This is a pretty significant number. What that meant was that they would have used up all their cash availability with their bank. They were going to be fully extended in all their debt, and they had about $17 million worth of debt, and they were still going to have $1 million cash shortfall. This would have led to a lot of really bad things happening. First of all, you can see this happened to be a payroll week of $900,000, so people wouldn't have gotten paid. If you want to really destroy your morale in a company, that's the fastest, easiest way to do it, is not pay your employees. The information here may look nice and neat, and it's formatted nicely, but this is really a hard sell to get management, senior management, to buy in. As I said, I was brought into the company. We had to convince them against all the things that they had happening for years. They had been very profitable. They had seen revenue growth. They've been able to expand locations. But now we were telling them that they were going to have a cash flow shortfall of over $1 million, and we're not going to be able to make payroll. It took a long time to buy into it, but the only way we were able to really convince them and help them understand the severity of the situation was by having had a cash flow forecast. Using this information then allowed us to start making adjustments to make sure that this $1 million didn't happen. Those adjustments included some really hard decisions. One of which, and again, this is something that, when you're used to operating one way and you're told you need to start operating that one way, things are not fun. We had to stop and convince them, or I had to stop and convince them that the new location couldn't be finished. It just didn't make sense. They were going to spend another $500,000 of tenant improvements. They were going to be hiring new people. All that had to stop, and had to stop now in September. Additionally, because they've been planning, for a sales increase, they had hired a lot of staff to manage a bigger business. That was also not happening. Again, tough decisions. Had to really look hard at the staffing that was there and make decisions on people and staff reductions. People call it right sizing and everything else. I'll cut through it. We had to fire people. And it's never an easy thing to do. But the main thing is that you have to think about it. The people you're letting go, it's very difficult for them. It's also better than having a company go bankrupt or out of business, and you're saving a lot of other jobs that are there. As I said before, when I got there, senior management had no idea the seriousness. They knew they had some problems. Using a cash flow forecast helped us point out, and have me point out to them, that if they continue on the track that they were on, this is what was going to happen. So a cash flow forecast is not something that is a surety that's going to happen in the future. It is basically saying, based upon the trends, what you're doing, the cash you've got coming in, the cash you've got going out, this is what's most likely to happen. So this is a huge tool to help you look at your business and make sure that doesn't happen, because we had time to make the changes. This actually did not happen. We ended up working and contacting with the senior lenders also. We restructured the loan agreement, and the company went on and made it through the year and had a solid next year. But cash flow forecasting is not only about giving you ideas on when things are going to be negative. They can also be used when you've got excess cash, and to help explain to people and help you understand the cash you can spend on other projects, other areas to expansion, and so forth. This particular cash flow forecast is one for a homeowners association that I was involved in. I just become a member of the board of directors. As you can tell, I like cash flow forecasts. That's how I look at most business. One of the first things I did was put this together. Because it was a homeowners association, revenues are pretty straightforward. They come in quarterly, they bill at the beginning of every quarter. But you can see that we also had people that paid late. You can see these are actual numbers. This is, again, an example of how you can put your actuals in, and then you can adjust your forecast out here. That we knew that people paid late, some paid early, some paid different times. but we had a pretty good idea. There really wasn't much we could do about changing the revenue since it was a fixed amount. The HOA had adequate cash. They had, $164,000 there. Matter of fact, it has $150,000 that was excess cash. The expenses were very controllable. We had a limited number of areas that we needed to track. So you can see things that, the biggest expenses are things like lawn maintenance, those types of things. That particular HOA had internet service and TV service as part of their service, a management fee, and insurance. We had like 3 or 4 big expenses you could track pretty readily. The previous association board, though, what they had done, unfortunately, was they had been delaying and deferring maintenance. That's why we had a big cash balance. The new board wanted to go through and make changes, and we wanted to expend not only the current year's budget for building maintenance, but also to make and correct these deferred maintenance items and improve the landscaping and the general look of the complex. By using this cash flow forecast, the board could look at and be assured that we had the cash that was there, and we had over $150,000 of cash that we could use for future projects. So you can see a couple of different things that we did and changed. The board, by the way, changed in March, so we were doing this planning in April and May and June. For the second half of the year, on the regular building maintenance, we increased that to $56,000, and the first half, the board had spent $15,000. Additionally, we put in a $75,000 major improvement project that we knew we could fund without having to go talk to the owners. Nobody wants to go talk to an owner and make an assessment. And we were able to do this, and we were able to really put the cash management to useful tool, make a lot of improvements to the complex, and do it with cash that we had on hand. It was only the fact that we had this cash flow forecast that gave everybody the comfort that we could actually do all this. This next one is a spreadsheet where I want to explain a little bit of the difference between cash flow and timing and how that relates to profit and loss or income statements. The top half of this is really just the cash reporting. This is simply when cash comes in, when cash goes out, and what balances happen. The bottom portion here, this would be looking at from an accounting perspective, the same data when you report sales and when you report profit. The assumptions I used here to make it a simple example, and one somewhat dramatic, is that this is a brand new company. They have a product that has a 50% operating margin or gross profit margin, that they're required to purchase all of their materials to make this product, and they have to pay for it 1 month in advance of being able to sell it. They have to assemble it. So that's why the cash goes out here for the cash for the direct cost or for the product. They have fixed expenses of $1,750 per month. And the company has initial sales of $1,000, but they're able to grow those sales by 25% per month. And again, this is all done for purposes of making a dramatic graph, which you'll see in a minute. But the company was in an industry that has net terms, selling terms of 30 days. What that means is that you get your payment 30 days after you've made the sale. Therefore, what's happening is the company is paying for their product 1 month prior to the sale, but they're actually not receiving their revenue on that sale until 1 month after the actual sale. You can see a couple of things happening here. One of which is with all the assumptions we have here, the company becomes profitable in month 7, but the company does not become generating cash until month 12. So let's take a look at this slide in a graphic format. You can see that this is the revenue, this is the profit, and this is the cash balance, or the amount of cash that's being used or in the business. You can see that, as I said before, sales are going up very rapidly. Profit is trending along right behind them. And in month 7, this is where the company crosses the break-even point and generates cash. Or no, I'm sorry, not generates cash, generates profit. But because of the dynamics that I set up in this, that you have to pay for your product a month prior, you get your payment a month after your sale, it takes till month 12 for the company to become cash flow positive. So again, from a P&L perspective, you're showing profitability in month 7. From a cash flow perspective, you're not really trying to generate cash until month 12. If you change one variable in this example, and that variable is really simple, we make the assumption that you now require your customers to pay you the month you make the sale. So keep in mind what the criteria was before. You paid for your product in the month prior. You sold your product in the current month. You got your payment in the following month. Making one change to where you get your payment for that product and your sales in the current month has a pretty dramatic change. And the reason I want to use this example was, as I said before, there's lots of variables that go into your business. There's lots of variables that go into cash flow forecasting. Another thing you can use with your cash flow forecasting is to change some variables around how you're doing business. If you change this, what happens to your cash? And if you look at it graphically, it has a pretty dramatic improvement. In the earlier analysis, cash continues to be used until month 12. Now you can see what happens when you make that one change. And that's changing of when your customers pay, so it more matches up how you have to pay. Cash starts improving in month 9. And you're almost to a cash flow break even in month 12, which is a pretty dramatic change with one variable. As I just said, there's lots of items that are going to impact your cash flow. Here's lots of variables that are there. I'll let you read through the list. This is not meant to be all encompassing. It's just a partial list, but there's a lot of things you need to think about with your business. Do your customers pay late? What are your payment terms? Do you use credit cards? Do you have to pay when you pay your fees on credit cards? But the very most important one on this to me is the very last item, and that is, if you realize that you're getting behind or are going to have any cash flow issues in any way, shape, sense, or form, you need to immediately start looking at how to solve that, working on solutions to that problem. And also, if need be, if you're using a bank, start notifying people that you may have an issue. There may be some things you can do. You can maybe get an overdraft protection if you have a very short-term 1-week cash flow drain. But the main thing is you don't want to surprise anyone. No one in business likes surprises, especially those that happen to be negative for your business. In summary then, I'm going to urge you to start using a cash flow forecast. It's a useful tool. It can help with the success of your business. As I said, it's not a traditional financial statement. It's really used as both an early warning system for potential issues and the availability for expansion and other uses of cash. And it's a look at a real-time view of your cash flow and your cash position. Keep in mind that if you've got a new business that's growing very rapidly, it may continue to use cash for a period of time. That was the example I put up just a couple of minutes ago. That doesn't indicate there's any problem with your business. It just means that when you're growing rapidly, you can use a lot of cash very quickly. You need to be able to fund that, because otherwise you could run out of cash and then stop your growth. You can be very profitable and still be needing cash to run your business. And lastly, my advice to you is, if you're not currently using cash flow forecast, please start. Additional resources you can look at, again, as Diane said, on the SCORE.org website, there's cash flow templates out there. There are various other online courses and tools and other resources that are there. There's financial templates, and you can also go to Minnesota SCORE. Diane?
Wonderful. Oof. Okay, so cash flow forecasting is a new tool I'm going to be using with my clients, I think. It sounds like it gives them a good heads up on what's going to be happening. So we encourage you to visit our website, score.org/Minnesota. There you can request a mentor, you can review mentor profiles and even choose your own mentor. You can also sign up for other workshops, remember, this is a 3-part series. This is part 1. You'll be getting links to sign up for the next 2 in the email that will also include the video of this presentation as well as Bill's slides. So you'll be able to look at those at your leisure. Click. So I think we have one more slide, Bill.
No,
Yep,
it just didn't want to click is all what's happening.
Thank you. Yes, so you will be getting a survey also about what you thought about today's webinar, as well as an opportunity to talk about what other topics you're interested in. I am the education chairman. I'm always looking for ideas for additional webinars. We have a whole series coming up that I think you'll find to be interesting, but certainly the next 2 videos or the next 2 webinars on financing will be interesting. So lastly, let's click one more time, Bill, and we'll get into questions. And you know what? You did such a fabulous job that there are no open questions in the Q&A.
Great. That means I've confused everyone.
I didn't even see any questions in the chat. No, other than will I be getting a copy of this video? And yes, the copy of the video and the slides will be coming your way via an email from our chapter. I think there are no questions, so we got a thank you from David. I want to thank you again, Bill, for sharing your knowledge. And this was eye-opening for me, I have to tell you.
Well, thank you. I mean, the concept here is very simple. As I said, it doesn't require accounting. It really just requires using simple math and looking out in the future and just sort of tracking it. And the more you track, the better people will be with it, the better they'll be able to anticipate what's going to happen with their business. And the key component for me is just knowing what cash you've got and what's there. I've used it for a number of years. It's not a standard financial tool, but this is something that a lot of private equity firms, other people look at as cash flow forecasting. And it really does help you prepare for things and helps minimize some of those surprises. As I said, the one thing nobody wants is a surprise.
I can only imagine the company that you went to when you showed them, oh, by the way, you're going to be running out of cash in a few months. They probably, it was hard to believe because they were so profitable.
Yes, it was if I just told them that without having some way to, show them that, it would have been hard for them to believe.
Yeah.
But by being able to do the math and show the math, that made life a lot simpler. And yeah, a lot of hard decisions had to get made.
I bet. Well, thank you very much, Bill, and we look forward.
And thank you, everyone, for not asking any questions. That's great.
We look forward to seeing many more of your presentations, Bill. Thank you so much, and thank everyone for coming. Thank you all. Bye-bye.